In this presentation, we will enter an adjusting entry related to an invoice or accounts receivable within QuickBooks Pro 2019. Here, for more accounting information and accounting courses, visit our website at accountinginstruction.info. We are in the home page. We currently have the open windows open. You can go to the open windows by going to the view dropdown and selecting the open windows list. This is going to be an adjusting entry for accounts receivable. To take a look at what is going on here, we're going to go to the reports up top. We're going to go to the company and financial, and we're going to go to the balance sheet standards. We'll take a look at our balance sheet. And we're going to change the date range up top from the customized reports, and we're going to change that date range from 01/01/19 to 02/28/19. So January and February 2019, and say OK. Our cutoff date will be February 28th, the end of February. Now, if we look at our accounts receivable here, we're thinking that we're going to make an adjustment to accounts receivable. Why would accounts receivable be wrong? It's possible that we entered an invoice here that we entered after the cutoff date. And so that's what we want to check here. We want to check, is our cutoff date right in terms of revenue recognition and what should be in our accounts receivable. Why might it be wrong? One reason is that if we think about a company like a service company or a company that like does bookkeeping, or like a law firm, CPA firm, typically in order for us to invoice a customer, we have to go in and count the hours that have been accumulated and then make the invoice. And that might only be done like on the 15th day of each month or something like that. And it's done for the prior 15 days. So in order to for us to be completely correct on an accrual basis, we may have recorded an invoice in March where the work was done, in this case, in February. So in our case, we may be recording an invoice already had been recorded, but it didn't get added to the right month, because the invoice, when we create the invoice or sales receipt, that's when the accounts receivable is triggered. That's when the income is triggered. And our goal here then is to go through and see, okay, are there any invoices we made in March that should have been brought back and recorded in February? Because that's when the actual work was done, and we have to record the invoice in that period in order for QuickBooks to record the revenue and related accounts receivable in the correct time frame. So how can we check that? And note that this is another area where we may want to do with a CPA firm to go in and check these kind of adjustments if they need to be adjusted for presentation purposes, if we are going to present for a loan, for example, or if we're preparing taxes. Otherwise, there are probably timing differences that if we're not presenting the data outside, we may not necessarily need to do this type of adjustment. Note, if we don't do this adjustment, then our income statement is a little off, because we're not going to be including revenue that we actually earned because we did the work this month. We're not going to be recording it till next month. But if it will work itself out in terms of a timing difference. It's just going to be a timing difference. Rather than recognizing the revenue in February, we're going to recognize it in March if we weren't to do this adjustment. But between February and March, it would be recognized. So to do this, let's see what we have here. How can we figure out whether or not an invoice went out in March that should have been in February? Now, note that when we do these adjusting entries, it's probably not actually February 28th right now, because we had to do the bank reconciliation and whatnot. So it's already sometime in March that we're going to basically finalize our reports for February. That means that we have data in March, or we would in practice. So we can go to March, which we'll do here now. I'm actually going to go to the income statement. We could do it in accounts receivable, but it's probably easier to see by going to reports, company and financial, and taking a look at the profit and loss. So we'll go to the profit and loss, changing the date range. Now, what I'm going to do is go to the first month after the month that we're working on. So we're working on February 28th. What if we were to go to a few days after that? Like if we were going to go to 03/01/19 to 03/15/19 and see what activity is there afterwards. And in this case, I just put this in there for the example problem because we haven't entered any data in March yet. But for example, if we saw this invoice, or we went through the invoices in March and we saw this item here in merchandise sales, if I double click on that, I'd see this merchandise sales. If I go through these and I say, I want to check those ones that are really close to the end of the month, at the beginning of this month and the end of last month. And I want to go back and say, okay, was the work actually done for this sale in March? Did we do it in the first 2 days of March, or did we do the work in February and bill it in March, send the invoice out in March, which is triggering the income. The invoice is what triggers the income. So if it was a service company where we did bookkeeping or law service or something like that, it's most likely that something like this would have been for work that at least partially was done last month. And so we should bring it back to last month to be on a proper accrual basis, because that's when we did the work, even though the invoice is what's driving it, and that wasn't created until March. The work was done in February. If we're talking about, in this case, like we are in this case, an Epiphone guitar, we sent a guitar. How would we know? What does the work even mean then? When did we do the work? We did the work when we gave the guitar. So one way to check it here would typically be, when did the shipping document go out? When did we actually ship the guitar? Or if we gave it to the store, then when did we give it in the store? If we shipped the guitar, when did we actually ship it? And if we saw that we shipped the guitar last month, but that we didn't record the invoice, didn't bill the client for it until this month, then we'd have to take a look at that. And that's the assumption we're going to make here. We're going to say, hey, look, this $5,000 is related to a guitar that we shipped last month, but we didn't get around to billing the client for this month for whatever reason. Also note that this is from an audit perspective. If you were to audit books and whatnot, this is one of those things you want to take a look at, because if somebody wanted to look better or worse, if we were trying to get a loan, for example, and we wanted to look better, we might try to actually increase the amount of revenue we wouldn't, but somebody might try to increase the revenue by transferring the timing differences and recording some revenues in this period, which should really belong to another period. Or they might try to have timing differences in terms of the expenses, recording expenses in the following period, which should belong to this period. Or on the reverse side, if they're trying to pay less taxes, then they might try to defer the invoice here and say, we don't want to record revenue, and therefore start to record revenue in the following time period rather than recording it in the time period that they would be paying taxes on. And that would kind of defer the revenue that would be owed. So that's the kind of thing we'd be looking for there in terms of the shipping document. How could you audit that? Well, you look at the shipping document and say, well, when did the actual inventory leave? That's when you should be recognizing the revenue. So if we double click on this, we can see this invoice. So our goal here is to say, okay, this invoice went out and we think that should be done in February. Now, one way we can change this is we could just change the invoice date to February. But we don't really want to do that because the invoice is kind of connected to the payment, and that would distort. If the client came back to us and said, hey, when did you send the invoice out? And we changed the date to the prior date, that could distort things. So we don't really want to change the invoice typically. We want to keep it in there on the date that we have. And therefore, we're going to make an adjustment just with a journal entry. So what we're going to do, and this is a really good journal entry to practice because it helps us to practice, what's the journal entry for an invoice, and then reverse it, which is a good practice. So if we think about the invoice, as we've done a few times, we could say that we know that the invoice means accounts receivable. So accounts receivable is going to go up by the 525, and then the other side is going to go to sales only for 500, and then we're going to have the payable be the difference of the 25. That's going to go to sales tax payable, and then we are going to have the inventory go down, and we're going to have the other side being the cost of goods sold. So it might be worthwhile even to put this into an Excel worksheet. So if we were to open an Excel worksheet and just kind of think about this journal entry, and we are going to use debits and credits here because this one is one that debits and credits would be a lot easier, in my opinion, to do. So we're going to use the debits and credits. So if we were going to think of terms of debits and credits, we would say the normal journal entry would be that we're going to have the accounts receivable. I'll just call it accounts receivable. It's going to go up. And then the other side of that is going to be sales. And then we're going to have the payable, which is going to be sales tax payable. So we can think of these as two different journal entries, even though they happen at the same time. So this is the first one. So sales was $525. That's going to be a debit. The credit's going to be $500. And the difference is going to be $25. And that will, of course, go to the payable. So this is one kind of transaction, and this would be debit and credit. So that's one half of happens. Then we've got the inventory, which inventory is going to go down. And we're going to have the debit of that is going to be cost of goods sold. And so we don't see that on this document, but we know we sold an ELP, so we can go to the lists up top, and we can go to the items lists, and we're going to go to the ELP, because the invoice is driving this, even though it's not on the invoice, $400. So the 400. So all this is happening. This is really the transaction whenever we make an invoice that sells merchandise. So what we want to do now is reverse this as of, or we want to enter this, sorry, we want to enter this as of the end of our period, at the end of February. We don't want to enter another invoice to do it. We could, but that's not, we want to enter an adjusting entry to show it's an adjusting entry. So we want to do it with a journal entry. Now we could try to do it with registers as we've done with prior adjusting entries, but it's probably easier to just enter this because there's multiple accounts. It's probably one where the register doesn't give us any more simplification if it has in the past or not. You know, it's probably easier for us to think about debits and credits really than try to do this with a register. So I'm just going to make a journal entry for this. So to do that, we're going to go close this back out, close this back out, we'll close that back out, and close this back out. And then we're going to go to company up top. We're going to go down to make journal entries. And then we're going to make the date as of our cutoff, 2/28/19. We're trying to bring this entry into the cutoff, even though it's in there afterwards. And you might think as we're doing this, well, that's going to make it in there twice. That means you're going to have it in there twice because you're going to put it in there now, and it's already in there as of 2 days from now. And that's true. And we're going to have to deal with that. So, and we'll deal with that by having a reversing entry. So we're going to pull it into this time period, and then we're going to have to reverse it. We're going to make these financial statements right as of the cutoff date, and then we'll fix it, we'll reverse it so it doesn't mess up the future, and so we don't have to delete the invoice. Okay, so we're going to enter this adjusted entry. We're going to say the first one's accounts receivable. And we could do the drop down, we could say accounts receivable, type it in there. And that was for, we're going to get $525. And then I'm going to say, we'll do an adjustment such as this. So something like this in the memo. It's going to be an adjusting entry for invoice in March, but work was done in February or something like that. Now, oh, and I have accounts payable. It should be accounts receivable. Accounts receivable. This one. Okay. Accounts receivable. And that's going to be the 525. Now the name here, we have to have a name because QuickBooks will not let us post anything generally to accounts receivable without a name, because that means that it won't be able to track the subsidiary ledger, like who owes the money to us. Accounts receivable means people who owe us money, and QuickBooks is going to say we need to know who owes you the money, or we're not going to be able to track by a subledger by customer. So the invoice was for Sam, the guitar man, and for our purposes, it doesn't really matter as long as we have the same customer, because we're going to reverse it. What we really want is for our balance to be correct as of this time period for the financial statements. But for any kind of other accounts that we're going to make, it would be necessary, so we might as well choose the correct, of course, customer here, the same customer that was on the invoice. And then we are going to credit the sales, which we could go here and say sales. That's going to be our income account down here. So sales, and it's going to be merchandise sales. So I'll type in merchandise sales, that's the one. But it's only for 500, remember, according to our journal entry, it's 500. And so it will have the same description. Now you could put Sam here as well, but it doesn't really, you don't need it there. It's not necessary to record the journal entry typically. And then the last one is going to go to whoever we pay for taxes, or it's going to go to sales tax payable, a liability account. And then this is another one it's a payable, and QuickBooks sets it up as kind of a special liability account that we need a vendor for. And so the vendor that we're typically going to have will be for whatever state we have to pay the sales tax to. In our case, it was the New York State sales tax. So that's just, we have that vendor. That's who we're going to pay the sales tax to. I'm going to copy this once again here. Now, this next one we thought of as a separate journal entry, and oftentimes we do that in book problems, to think about this as a separate journal entry, even though they happen at the same time in a perpetual inventory system. But we'll just record it here. In reality, it happens at the same time, and we'll enter it in the same area here. So now we have cost of goods sold, and inventory is going to be the other side. Inventory is going down, and cost of goods sold for the 400. So we're going to say that this one's going to be cost of goods sold. It's an expense. If you hit the drop down, it's down here. They've got the cost of goods sold, cost merchandise account fee. So we're going to go to cost of goods sold, and that's going to be for 400 debit. And we'll copy this again. And then the other side of that is going to go to inventory. So maybe it's merchandise inventory. We'll click the drop down. It's going to be the inventory account. They have merchandise inventory. No, they labeled it inventory asset. Inventory asset. So we'll pick that one up. And this is going to be our transaction then. So we will copy that and put that there. So here is our adjustment. We're going to increase accounts receivable, increase sales, increase the payable, then increase the cost of goods sold related to the sale of the inventory, and decrease the inventory. We're going to record this to the accounts receivable of Sam the Guitar Man, and the sales tax to the vendor of New York State sales tax. You might be questioning here, what's going to happen with this inventory? How are we going to be able to track that on the subledger account if we're not addressing which inventory was sold, the type of guitar that was sold? And that is a problem, and that's why we don't typically make a journal entry such as this in order to sell guitars. In other words, we don't just pick the inventory account. We usually use those items to drive it so that QuickBooks can tie that out. However, in this case, what we want to do is just make the financial statements correct as of this point in time, and we're not too worried about the sub account as long as we adjust it going forward, and we will do that with a reversing entry. So we're going to say save and close and see if this does what we would expect it to do. So let's go back to the balance sheet, and we're going to go to the accounts receivable. Accounts receivable should now have increased. So if we go here and we scroll down, we're going to say there's the journal entry we just made. Here's the adjustment. Notice it's a journal entry, and that's helpful to us because now we can see that this is an adjustment we made. So if we didn't do a reversing entry, or if we give this a separate department did this, like the adjusting department versus the accounting department, then the accounting department could say, oh, that's something that the adjusting department did, that's one of their adjusting journal entries. So if we double click on it, then it takes us here. It's trying to take us to a register again. If we double click on the journal entry, then we'll get to our actual journal entry. So that's the one side of it. We're going to close this back out. The other side is going to be on the profit and loss. So here it is in March. We're going to go back to the prior time period, which is 01/01/19 to, let's say, 02/28/19. So this is the point in time as of that we're going to make the financial statements, the cutoff date. So we have merchandise sales then, should have increased. So we're going to double click on that. And there's the 500 we pulled in. Again, it's a journal entry as opposed to an invoice or sales receipt, which is typically what we would see in here. And if we double click on that and double click on here, we get back to our journal entry. Closing this back out, closing this back out, closing this back out. The difference then is going to go to the 25 sales tax payable back on the balance sheet, back to the balance sheet. And we're going to scroll down to the liability where we have the sales tax payable. Double clicking on that. Scrolling down, there's our 25. It's a journal entry as opposed to sales receipts and invoices and the payment that we made for the sales tax for January. Double clicking on that. Double clicking on the journal entry. There's this one. So we found those. Now we're looking for inventory decreasing and cost of goods sold, the final components. Closing these out. Back to the balance sheet, we're going to say inventory is going to go down. So if we go to this inventory, double clicking the inventory. Once again, journal entry, inventory decreased 400. Double clicking those items. There's the journal entry again, there's the 400 decrease. And then closing this back out, last component that we get to look at, profit and loss, income statement, cost of goods sold. Double clicking that item will bring us to this journal entry. Once again, journal entry as opposed to invoice and sales receipts. Double clicking the 400, we get back to our journal entry. So this is in essence pulling the invoice in journal entry format to the current period in which the work was done, as opposed to closing this back out, closing this back out, closing this back out, the next month, which is when the invoice was made. So remember the issue here is that QuickBooks is going to use a form to trigger when revenue should be recorded, and that form's an invoice, which is good but not perfect because revenue should be recognized when it's earned. So it's very possible that we enter the invoice a good deal after the time period in which we have earned the revenue and therefore need to bring it back. Now, note that we do have a problem here in that this revenue has been included in February, and we know that the invoice is in there in March. So we're going to have to deal with that, and later we'll do an adjusting entry or a reversing entry in order to fix that. And one way to do that is just to reverse it as of the first day of the next month. And we'll talk about that when we do the reversing entries. Also note that when we go to the balance sheet, we back to the balance sheet here in the open windows, we made the accounts receivable backup should be correct, but now this inventory, if we go to our report for the subsidiary account for inventory, our ledger, reports up top, if we go down to inventory valuation summary, as of 02/28/19, we've got the cost valuation here at 1712, and if we go back to our balance sheet, it's at the 113, so 1312. Whoop. So it's 1712 minus 1312 is the $400 difference. So just be aware that unlike the revenue, the accounts receivable forces us to enter a customer, we just entered something into the inventory without telling the system what inventory item was used. And QuickBooks didn't even tell us about that. It didn't say, hey, you're entering something into inventory and we're not able to track that on the ledger. So that's something you need to be careful of. We need to be careful of here, and we need to be careful of it anytime we are tempted to enter something into this inventory account. In other words, if I double click on this inventory and I see anything in here other than a sales receipt or a bill or check register, a sales receipt, invoice, or bill, then it may be the case that, for example, here something was entered into it and it wasn't supported, and therefore our tracking mechanism over here that's supposed to sort this number, supposed to tie out to this number, will not tie out, and we'll have to go in there and make adjustments. It will fix itself, however, of course, once we do the adjusting entry or the reversing entry, which we will do, and we'll do it as of the first day of the next month. For more accounting information and accounting courses, visit our website at accountinginstruction.info.